All right, welcome everyone. Welcome to the Hurley Investments Market View Commentary for Monday the 22nd, 2023. I'm going to let you know right now, next Monday, our webinar will be on Tuesday because it is Memorial Day and the markets are closed. So we will be we will have next Monday off. Do the best you can to try to remember. Next Monday is going to be pushed till Tuesday, and we'll talk on Tuesday on a shortened week. All right, I've got some interesting conversations that I was able to have over the weekend, and one of them is from a VP of Zions Bank. And it's kind of funny because someone was like, well, what kind of VP? And let's just say he is way, way, way up there. My house, 6,800 square feet. His house is 16,800 square feet. So I had a talk with Zions Bank and the VP. The main question was, this came from me, how are banks really? You know, my question was, hey, you guys have been killed. They are up like 20% though from their $23, $24 lows. I'm like, how are you guys doing? What's really out there? And what do you think he told me? The 15 of you that are here today, you actively watch the market. What do you think a VP that's a friend high up in Zions Bank, what do you think he told me about the banks? Kind of wish Abraham was here today. Well, that's to be expected. The CEO of Silver of SVB, Silicon Valley Bank, made sure to get his 10 million while the bank went under. All totally legit. Gotta love it. Strong but tenuous. That's a good way to put it. Does he lie often? I have not seen him lie yet. But that is because I did have his kids with me in Scouts, and he knew I might leave him way up on a mountain somewhere without a way to get home. It's amazing what a dinner will buy you with the wives that just enjoy themselves and we get to sit and have a talk. Probably individual banks may be in better shape than others. Pretty interesting, because here was his comment. 30% of lending ability was, he said, shot, canceled, when we didn't roll bonds, and another interest rate hike, can't spell, and another interest rate hike will cut lending opportunities by another 20%. So a couple weeks ago, I talked to you guys about, hey, they borrow against this. On paper, the value is this. They still need to have, I mean, technically it still is worth a certain dollar figure. when the bond gets called. But is the U.S. going to call in their lower interest rate bonds early? What do you think? Does it make any sense for the U.S. Treasury to call in their cheaply borrowed bonds at 0.5%? Any reason they'd want to call those cheap ones in early? Yep, and Christmas is tomorrow. Yeah, of course not. They'll keep those out. If they start cutting rates, they'll put the call in on the bonds that are more expensive, but there are 30-year bonds out there paying 0.5% that the U.S. government will never call in early. It just won't happen. They'll let those sit. So if I do my math, it's like 55% of their lending ability when we raise hikes here the second week of June, June 14th. So I should say, let me put this slide here. June 14th, 2023 is the next rate hike. We'll put most banks without capital to lend out. And they're in trouble again. If they're run on banks, if people want to pull their money out, that is going to be the problem. Then it becomes how quickly will we see cuts? Is there anyone here today that thinks we're going to see cuts this year? Is anyone here on the side that says, you know what? Banks are going to cut rates this year because that is one of the optimal things to do. Bill, we got one that says, yep, and Christmas is coming soon. Both you guys are on a Christmas run today, seems like. Okay, so we're both agreeing for all intents and purposes, there's no reason. Well, I guess it comes down to credibility, right? There's no reason for the FOMC to cut rates early. They lose their credibility. We all know they overshot, but we probably have at least another quarter point rate hike coming up in June. They might say they might pause. I'm looking through my stuff. I think it's in 2 weeks. No, not in 2 weeks. In 3 weeks. Man, hold on. I'm trying to find where they had that. The day that they have their rate decision, they have the PPIs. The day before, on the 13th, they have their CPI numbers that come out. So rather interesting on where we're going to be at that time frame. Will the debt limit issues impact banks adversely? Well, if we don't get it solved, it affects our economy and the ability for our banks to lend or borrow against U.S. Treasuries. So the short answer is the fear of defaulting on our obligations affects countries willing to do business with us. it's not necessarily a bank issue as it would be a country doing business type of issue. So that would be the short and the skinny right there. All right, let's see what else we have. Well, if I can, maybe I'll just go that a little early here. I pulled it out now, but there are obviously going to be some hard choices if we can't figure out how to deal with our debt ceiling. Should we just blindly spend money? No, probably not. But we've got a deadline. This was printed today. So we're 10 days away from the deadline. If you ask me, it's going to be solved. It'll be a midnight, but it is going to rock our markets. So you will notice in our accounts, we have already put protection on, not only for transfers, not being able to do anything, but because we have no faith that this won't be done in an orderly fashion, and that, boy, it's going to rock the markets if we go to a midnight witching hour, if it delays a couple days into June. Not going to help us out. GOP skepticism of the June 1st deadline. Biden is not really willing to move, and to make to make it even better, McCarthy is stuck between a rock and a hard place. He really can't, with his constituents, agree to a debt ceiling. Some bills might go unpaid. In fact, I've already received from MoneyBlock the concern that, hey, you might not get your bond payments for some things for your bonds that you're in, Hurley Investments. You might not get your bond payments in a timely manner. You guys can't see it, but I'm trying to pull up that. I'm doing the best I can to try to pull up that email. MoneyBlock. Let's see if I can't find that one. And I'll copy and I'll paste it on up here. Pretty interesting. All right. So I'm sure I'm making you guys all sick. Debt ceiling. From MoneyBlock, May 17th. Federal debt ceiling. Congress is currently debating if the U.S. debt ceiling will be increased to prevent any defaults. If no agreement is met, the U.S. Treasury will be forced to default on its debt by June 1st, 2023. As per the debt ceiling SIFMA playbook held on May 3rd, 2023, the default could follow three possible scenarios. Delay in principal payments for maturing bonds, maturity dates are pushed forward, delay of coupon payments due, the maturity date is not extended, no principal payment is made. This is the least likely scenario where they default on everything. Basically, we are being told you need to watch out for clients that are going to have some type of debt ceiling payment expected from bonds. It might not be there. There might not be that opportunity. A little bit differently. Lastly, you should consider the likelihood of greater volatility in option expiration, which could have an impact on in or out of the money option assignments. They are giving it to us right now. The brokerage houses are not considering the government will get this resolved in a timely manner. If it is a 12th hour, things will be signed, but we're looking at about a week to 10 business day delay. And that's what we're up against. The real life of all this, it's a little bit scary. The government can't get their act together. That is really the best way to say it. The government just cannot get their act together to get things taken care of in a timely manner. And it's a little bit on the fearful side because, for hell's sakes, we pay our taxes. Our taxes can't be late. They fine us like there's no tomorrow. And it's just going to hurt our standing in a government, how do I say it? It's just going to hurt our standing in the view of the world. And that's something to worry about. Once again, I had someone present something to me that I found a little interesting in regards to S&P averages versus a real return. So I was working on some things for them. They somehow brought to me, hey, Kevin, the S&P averaged 13.6% over the last 10 years. To where I promptly said, well, I call bullshit. I know that went over really well, right? My simple answer was, hey, with all due respect, I call bullshit. There's no way it's been up that high, and it hasn't been anywhere close. And they came up with, well, yeah, I'd be up like 250%. So what I did is I created this spreadsheet, and I took $1,000 that he would have had in 2013. This is all hypothetical. And I said, okay, you take that $2,000, that $1,000. I did it on an easy $1,000 increment. I said, hey, you take that $1,000. If you look up here, I've got my formula. You take itself, the $1,000, and you multiply it by the 13.16%, right? He's like, yeah, that's how it goes. And then next year, you take that $1,136, and all you got to do is just kind of move it on down. You take that new growth from the previous year, multiply it by itself, plus the 13.6% return. And very quickly, I said, okay, so you're telling me that if you just put yourself in some index fund, you think you'd be at $3,579.18. And his comment was, exactly. So what was the problem? Number one problem with him calculating his average rate of return for $1,000 over the last 10 years, starting in 2013. Can anyone tell me? What was the problem with his average rate of return that he thinks he has over this time period with that rate of return? Anyone? Did not account for fees and losses. I like that one. Hasn't accounted for real returns. And you're probably seeing it because you see a real growth rate there, right? It doesn't account for years losses against the balance. Exactly. In fact, as I'm going through this with you guys, right? The understanding is this is not realistic. He's compounding interest as if every year the market gave him a 13.6% return. The reality is it gave him, 136% return from where you started in 2013 to where you ended in 2022. And if you take 136% return and slash it by half, hey, there's how you get your money. This is the problem with all those poor people that do financial plans. The financial plan is just a number that's compounded as if the market gives you an ATM type of return every single year. When we took the real growth rate for him, 26.6, 11, minus 7.3, when we went through it all, he actually came off only about $900 off. 882, right? Which in this case was only off by 20%. And he was like, hey, they're mutual funds. And we went through the two that showed they had these returns. One had a 5.35 or a 5.378. So it's 5 3/8% interest or, fund fees. The other one had like a 7.875, which is 7 7/8%. And you deduct all that out of there and you're screwed. And the next comment was, and if we have another 50% down year, all of this reverts right back to your $1,000. And you don't get anything for it by sitting there. And he kind of scratched his head and said, well, in the last 5 years, we should have done really, really well. And so he worked his last 5 years right over here. In the last 5 years, you had an 8.72% return. If you start investing your money in October of 2018, the market actually gave you even less, gave you about a 5% return. Because there's a big drop, a 20% drop or so, the last quarter of 2018. So his comment was, well, I can't trust Vanguard. I'm not happy with I'm not happy with my money manager. So my answer was, well, I know a money manager that has an opportunity for you. I know somewhere where you could place your money. I know someone that does something to protect. Well, not that I don't like you, Kevin, but I think I just want to go to an S&P growth fund. I think I'm just looking to put my stuff in there, and I think I'm just looking to maybe not have to worry about it. And I politely said, well, if you were to do that, to get back to the highs, all I did is I took the high minus where we're at, took that difference between the two, take that difference and divide it by where we're at today. I was like, well, just to let you know, realistically, if you were going to get into the S&P 500, you've got like a 14% upside growth rate opportunity. He was like, that kind of sucks. Like, yeah, that might be for years. Well, I'm going to go into Apple. And I said, well, if you go into Apple, you've got about a 5% growth rate. 5% increase in your money to get back to where it was at the highs. And he scratched his head and he said, well, what do you think I should go into? And I said, well, I'm just going to show you some of the opportunities from some of my clients with some of those stocks that could get back up to their highs. And I worked my numbers on those ones. Bank of America has a 78% upside opportunity for people that would invest in Bank of America from today if it got back up to its highs. Boeing has a 118% opportunity, just getting back up to its highs. Baidu 186%, Disney 122%, Ford 122%, JP Morgan at 24%, Meta has a 55% upside, Micron has a 49% upside, and this was before today. That's higher. And Under Armour has a 280% upside. Ma just said, but weren't those highs very extended based on free money during the pandemic? No, most of these are less than 18 months old. Less than 18 months old were their previous highs. But it's funny because he said, yes, but what if you did what you did and you added 30% or 40% or 50% more shares? And then I said, well, if you do 50% more shares, you now have double the return on some of these. If you had 30%, it's really like 60% more return on these. And he kind of got it. He's like, so if I got another couple $100,000, I should turn it over to you. And I'm like, hey, it's what you decide to do, but this is the opportunity. You'll never get a plus 30%, plus 50%. Back in 2020 or 21 for us, we're at that 46 on the low side, 60 on the high side. You'll never get those opportunities sitting in a fund. This is what you'd expect your money manager to do, to offer you these opportunities or just sit in a fund and get paid 1% a year for doing nothing. What do you think you should do? And he scratched his head and he's like, give me the paperwork, let's get you signed up and let's get going. And I'm like, boy, that's not too hard to figure out, is it? Those are what we're looking forward to. We do not have a time frame. It would be foolish of me to create a time frame. It would be foolish for me to act like I know a time frame. That is the opportunity that we have placed in front of us. There's no guarantee it's going to go back there. I had someone talk to me about woke Disney. I said, I know, but they fired their head guy. Well, there's an article that came out about their brick and mortar stores. I'm like, I know 3 months ago they were at 100. They're at like 22 now, right? Yeah, and those are going under for Disney. I'm like, I know. Thank God they don't make anything on those. We get it. We do the fundamentals. Oh, Ford has its Rainbow Raptor coming out. I know. They didn't publicly put that out there, but I know. It's the fundamentals that will pay out over time. I'm going to read what it all means here, just so you have an idea of what the market is up against and what makes the market worry. What it all means. The earnings outlook is brightening according to the consensus view of things, which it is. In fact, in all reality, the consensus of the market actually looks remarkable. I have no idea how we look so good when we're looking so bad at the same time. But on an earnings consensus, we really do look amazingly well. That is a hard view to swallow, but to be fair, the consensus earnings view for the S&P 500 is an aggregate of individual earnings estimates for the S&P 500 components. And right now, I've heard as much as 8 stocks are running over 50% of the S&P gains this year. Some companies will be reporting actual growth, others will not. Some companies will deliver positive earnings, others will not. One has been rewarded so far this year for owning the market cap weighted S&P 500 because the biggest stocks have delivered some of the biggest gains. It might surprise some to learn, though, that nearly half of the S&P 500 is down for the year. And actually, it's closer to like 58.3% of the S&P 500 is down this year. It's like 2.8% is up and up big for the year. The rest are pretty much flat. 2023 may indeed fit the bill of being a stock picker's market. But stock picking has not been easy. Duh, tell me about it. If you haven't followed the herd into the mega cap stocks. It may not get any easier, which isn't to say that it will only get better for the mega cap stocks. If the economy and earnings go the way of the leading economic index suggests, they will go. Therefore, one needs to be careful about overpaying for projected earnings growth, whether they are buying the S&P 500 market cap weighted index, which trades at 18.3 times for 12-month earnings versus the 10-year average of 17.3 for an individual stock. In aggregate, the earnings growth outlook from here appears relatively attractive according to estimates, yet the economic growth outlook appears less so. That point might get lost with the Atlanta Fed GOP Now model estimate calling for a 2.9% real GDP growth in the second quarter, but the leading economic index suggests it'll be found again in the back half of the year. Once again, a lot of gibbery gooberish that basically says, we don't know. We don't know. We're not sure where things are going to end up. All right, looking at the Dow, I kept it like this. We are now bearish again on the S&P 5, on the Dow Jones Industrial Average. We've got our crossovers. We are bearish on all 3 technical crossovers on the Dow. Whoop, 31 stocks are bearish. S&P is still bullish. Not hugely bullish, not a big day, but we are technically bullish. We've had a little bounce off of the median line, 100% due to earnings. And the mega cap stocks this year, remember, I don't know if you remember the reports we were showing you. Technology is going to be awful. You heard it from Hurley Investments. No, you should probably be in the tech stocks that it won't matter if there is a recession. It's doing best. It's actually bullish and just approaching the overbought category. So that is something to worry about or to pay attention to. You typically don't like to see positions overbought, but that is what's happening on the NASDAQ. It's actually moving pretty darn good, all in all. This week, pretty quiet week. Hewlett Packard has some reporting that it's doing. FOMC minutes on Wednesday. Earnings, Hewlett Packard tomorrow. GameStop, Nordstrom's, Salesforce on Wednesday. Dollar General, Macy's on Thursday, Broadcom, Dell, and Five Below on Friday. New home sales on Tuesday. FOMC minutes will be interesting, trying to catch a peek at where we might be at for a rate hike coming up. PCE, durable goods will be the big ones on Friday. We do have GDP. I don't know. For the first time in forever, I'm not really excited about a GDP number. I don't want to say it doesn't matter because the GDP always matters, but it seems like they're more pressing. Seems like there's more pressing issues that we're going to be facing here than our GDP number to see our stock market move higher. So again, not that I'm not worried about it or paying attention to it. It's just not as important to me for this week for some reason. An interesting article. The end of the runway is nearing for lofty tech and soggy banks. Get ready, says this strategist. It's a really good article to look at some things to say, hey, pay attention to this because there could be a problem. Interesting article on Ford and why on their capital day today they're trying to impress people, so to speak. They actually did pretty darn good today on what their forward opportunity is. It would really be something important to read. Not to mention, Ford is paying a 5.15% dividend right now. Ford is super, how'd I say it? Super attractive right now in the dividend arena. So that's just something to think of in regards to Ford and why we're still in that loser stock, as someone told me recently. Interesting, Apple trades flat on rare downgrade. Here's what the pros have to say. The short answer is, who the hell is Loop Capital? All the bigger names are still in it and happily in Apple, looking for a price downgrade so they can buy in at a cheaper price. So just something to pay attention to there. And I've got the China action against Micron. Of course, we've done it to their chips. Here they are doing it back to ours, and expect it to be a couple other companies other than just Micron that you'll see China play tit for tat. With that said, any questions that anyone has today? Are there any questions that you guys have that I can do my best job to answer for you? Okay, so how's the transfer coming across? The transfer is coming a little bit slower than we expected. I'm not a fan of AI. We're having an issue with the clearinghouse that has two brokerages that clear through it, can't get their artificial intelligence to pick the right bank account numbers and transfer numbers and account numbers. So we're doing it all by hand. That's why it's taken a little bit longer. We're just doing it all by hand, and we'll get it done when we get it done. Most of you it's taken care of. Corporate accounts, it's been a little bit harder, but we're burning the midnight oil to get everything turned in and everything done in a timely fashion. We've already had accounts $1 million or more that can come over in 3 days. So we still have plenty of time to get things done that we need to. And no money is being lost. Correct. And really the neat thing is we're excited to start to be able to protect the way that we used to be able to protect without restrictions against adding a couple extra contracts. Well, you can't do it in these type of accounts. It's like, oh, bull crap. Just get us taken care of. This is not that hard. So, William, there's your answer to your question. Are there any other questions? Kevin, why do you still believe in the stocks that you believe in? So the short answer is I am a fan of Buffett, and I do what's called Buffett investing. I look for shares that are undervalued, that have the opportunity to increase by 20% or more. For those that were in Ford, we got out of half of our Ford shares way back when Ford was at $25 and between 25 and 40 cents. When it got as high as $25.87, it was fully valued. So we got out of half of our shares at that time because it was fully valued. Only half because the market may not have seen that and it kept going. Only half because it paid a good dividend. There's still some upside opportunity. So I'm in the positions because we're in undervalued stocks. If I was to go back to some of these and take a quick look, I don't think Bank of America is going anywhere. I don't think Boeing's going anywhere. Baidu is definitely not going anywhere as it keeps getting bigger and bigger and having good earnings. Disney's a skeptical one, right? Oh, they're losing in here and here. The reality is Disney's numbers look great. Their political slash media coverage is not so good, but they look really good overall. Ford should be doing significantly better. Fundamentally, it's a great sound company. They're not going out of business. JP Morgan's not going out of business. Meta's making the turn. They look fabulous. Micron has done a great job, and they're going to get billions of dollars come here in October to create more chips. Under Armour, the cheapest retail out there with a great product, great numbers. For years they had a bad PR firm, but they're coming back. I don't see anything wrong with these. Could you stick in here Pfizer? Pfizer might be a really good next stock to look into. But concerns with Pfizer, they're losing a lot of their patents. Doesn't mean they're not going to get more patents for, I guess it's obesity right now is the next big one on their list. But their returns for the next year might not look really good because they've lost some patents. Pfizer is an opportunity. If you're going to look at energies, I really like Halliburton. Halliburton is a great gasoline energy company that that's just been kicked in the teeth. A $30 gas company doesn't make a whole lot of sense. Marathon and Murphy Oil also seem pretty good. So just taking a quick look at these, I've got some right now that I'm like, for crying out loud, what a fabulous low-priced stock Halliburton is. $30, way undervalued. You can actually go through to FinViz and take a look at some of these and just start to look at their numbers and be like, for crying out loud, get your teeth chomping. Get ready to find some more positions that are way undervalued. What an opportunity you can see in Halliburton based on past performance. Not only that, but if you look at the short float right now is outrageous. It has a short float of 3.16%. The last time I showed this to you, it was something like Meta, and Meta's been on a tear plus 40%. So there are just some opportunities that I seem to see right now. Murphy Oil is one. looks just like Halliburton 36. If you take a peek at this one, you're going to find a lot of the same things on this one. A 4.9% short float rate. It's ridiculous. Growth, fine. This is a ridiculously cheap price stock. And then you stick over to Marathon. Why did that not come through? MRO. Excuse me. MRO, I forgot it. I tried to do MOR. There you go. 3 ridiculously cheap oil stocks that if you're looking to enter the oil, I wouldn't be doing it with Chevron, British Petroleum, ExxonMobil when you have these type of opportunities. So hopefully that answers your question there. Any other questions you guys have? If not, I appreciate you guys. Have a wonderful evening. And I'm trying to stall to see if anything else comes in. Yeah, if not, guys, have a wonderful evening. Kohler, paperwork tomorrow morning for you. Gupta, we're about an hour and a half from having your paperwork ready for you. And I think everyone else I see here, paperwork is already in, and you'll start to see processes happening this week. All right, guys. Hey, appreciate your time. Glad to see you. Have a great evening, and I will talk to you soon. Bye-bye.